Hi, everyone. Today is sadly the day that Ukraine was invaded by Russia. Actually, it might be recorded as yesterday because it was so late last night, February 23rd, 2022, and today is February 24th, 2022. So I was already going to have an investor to-do list for buy and hold investors as well as pie chart investors. And the difference between the two, you'll learn over the course of this video conference. And now it has even more validity, more importance now that we have wartime on our hands. So what happens to stocks during invasions and turmoil and all the things that are going on? What happens to the stock market? And what should you be doing to protect your wealth and not to freak out? So we can discuss all of that in just a moment. Okay, I'm going to pull up a bunch of charts and I will be back shortly.
So yeah, today, obviously, we have to talk a lot about how the stock market reacts to invasions and wars. And we have plenty of data to inform us about what that looks like. So I'm going to show you a blog that I just posted, and that is called, hold on, it's right here. So this is about the Ukrainian invasion and how has the market responded to past wars. So I do encourage you to read this so that you have a preview of, what can happen over the next year or two. Also, I want you to read it because I think it's important to know that there can be mini rallies. Like, I don't mean many like multiple, I mean like little ones in between a general downturn if there is going to be one. So as an example, everybody thinks that the stock market crashed after 9/11. As I point out in that blog, the markets had had a lot of a correction. The NASDAQ was even lower than the Dow before the 9/11 event. So by August, the end of August, stocks were actually very cheap. And then when 9/11 happened, they did go down again, but then they had a rally and a Santa rally that year. And as an example, I had purchased a lot of stocks on the cheap in August of 2001. One of the stocks that I purchased had fallen from $12 a share down to $1 a share. And by December of that same year, just 3 months after 9/11, I had almost tripled my money. So don't think that that you should try to jump in or jump out or all in or all out. And also, don't be devastated if something is down. I think what's really important is to be properly diversified and to have a plan that works well when we have a lot of, sadly, conflict. We're not embroiled in the fighting, but we are embroiled economically. That will impact us. So what can you do? And I did in my email out to you and also in my signage for this, I talked about two different types of investors. I mean, there's many different types, but there's two main types in terms of retirement plans and people that are taking a longer term approach. One is buy and hold. And the other is my strategy, which is based on modern portfolio theory. It's a proper diversification model with regular rebalancing. I call it pie chart investing. So let's start out with buy and hold. And here are 5 very key things that you want to do right now if your strategy in the past has been buy and hold. Number 1, you want to know what you own and why. And I don't mean that you take a look at your brokerage statement and you say, oh, great, I have 18 pages of stocks and my broker tells me I'm diversified. So I know what I own and I'm diversified. And it shows right there in those 18 pages that I'm diversified. That's not at all what I mean by know what you own. I mean, and I'm going to show you a chart, how properly diversified are you really? If you have 18 pages of holdings, where do they fit in a diversified plan of large, medium, small, value and growth and HOTS? Also, we're going to talk more about the safe side in a moment, but most people, if you have a managed plan, this can be very true. I do a lot of second opinions, so I look at a lot of managed plans. Most people have a boatload of large caps, mostly large cap value. If you're lucky, you had large cap growth because that well outperformed large cap value. They have almost no mid caps or small caps, and they are definitely, if they have anything that's hot at all, it's usually something that's kind of obscure and maybe not really that hot. So knowing what you own and why means that you have to be giving your portfolio a second opinion. It's not blind faith that somebody else has diversified you. At least know what modern portfolio theory is and what it looks like. You can get that information in the ABCs of Money. Again, that's the cost of what, $5 for an ebook. So it's not going to break the bank here. There are samples of everything we talk about there. Now, one caveat, if you are going to go and get the ABCs of Money, and again, I don't make a lot of money on your $5 ebook, so I'm not telling you this so that I go to the bank on your buck. Be sure that you get the 5th edition. Go to nataliepace.com, simply scroll down, and you'll see my most recent editions of the books there. You can click over. You can get, they do not do the audiobook for this. It's not updated for the 5th edition. So you can get the print edition or you can get the ebook. Okay, so the second thing that you want to do, if you're a buy and hold investor, is you want to go back to your brokerage statements and take a look at where you were, where your asset value were, your whole portfolio value was in March 23rd of 2020. And you want to compare that to where it was February 19th of 2020. Because if you had 40% losses or around that, then you're riding a Wall Street roller coaster. And that means that if the markets go down, that you are at risk of going down. Now, as we age, we have to keep more safe. That's not going to be riding a Wall Street roller coaster. So if you are riding it, and by the way, bonds and bond funds didn't do very well in March of 2020. If you are losing that much in recessions, then you're way more vulnerable than you know, and you definitely need to get an unbiased second opinion. You need somebody like me to look over your plan, tell you exactly what you own, and show you what modern portfolio theory could look like. And then, you know, if you're the boss of the money, of your money, you should, you know, make the changes that you need to protect your wealth. Number 3 is that you want to get a performance chart of 15 years. So what your portfolio has done versus the S&P 500. Now, the reason I say 15 years is that that will show you what stocks did in the pandemic recession and the Great Recession. Now, most people are, again, they're riding the Wall Street roller coaster, so they're doing pretty much the same thing that the Wall Street is doing, the Dow Jones Industrial Average, but 2% under due to fees. Now, I'm not against broker salesmen making a commission. That's not why I have you do this. It's more, again, that, you know, it's not a good plan to lose half of your wealth in a recession and then have to use, you know, at least half or more of the bull market to make up losses. There's many, many reasons why that's a bad plan. I outlined that in the new blog. So be sure you read that new blog on the Ukrainian invasion. So that's key, is that you want to know whether or not you're riding the Wall Street roller coaster. And then number 4, you want to get the 21st century reality. Now, what is different about the 21st century versus the 20th century? And there's a boatload. Higher asset values, for one, both stocks and real estate, way, way higher, and in some ways outlandish. Let me show you what I mean. So if we were to look at what's called the Buffett indicator, which I think I have right here. So this is the total market versus our gross domestic product. It's put together by the St. Louis Federal Reserve Bank. And as you can see, there was only one other time that came close to how overvalued stocks are based on this indicator, and that was .com in 2000. You can see that it came close in the Great Recession too. Now, these gray bars are recessions. So after these market highs where asset prices are extremely elevated, there tends to be a recession. Also, if we look at the CAPE ratio, and this is done, it's slightly different, but it's the same idea. It's a price earnings ratio average over a 10-year period. And as you can see here, this is Robert Shiller. He's a Nobel Prize winning economist that's a professor out of Yale. As you can see here, .coms show up more overvalued on the CAPE ratio. Today is number 2, and the Great Depression, when stocks were generally considered to be very, very speculative and overvalued, is now number 3. So 2 out of 3 are in the 21st century. And of course, the only time it happened in the last century was during the Great Depression, and we all know what happened then. So what do I mean by this century is not the same as last century? We are dealing with asset bubbles in this century. And when asset bubbles pop, they drop farther and faster than a normal recession. So it's important to be aware of that trend. Number 5, and again, this is the checklist for buy and hold investors, is that you want to be the boss of your money. I know it's so funny. I mean, it's not funny at all. It's actually sad and heartbreaking, because a broker salesman, a good broker salesman, especially one that's managing your money and is going to be with you over the long period of time, is going to be kind of like a friend, right? But the truth is, if the markets fall by half and you lose half of your money, you're not going to consider them a friend anymore. So when the bull market is happening, if they're good salesmen, then they are like a friend to you. But it's going to be very hard for you to feel like they're a friend if half of your money goes away, right? But the truth is, it's your fault, not theirs, because they are doing the plan that either they believe in, and there's many broker salesmen that believe in buy and hold. And by the way, that is the way that their brokerage is set up, with products that are buy and hold products, and that's how they make their commissions, that's how they make their money. So they believe in it. Now, why do I say it's your fault? Because it's your money and you're the boss. That person that's managing your money, you should be thinking more like a CEO would think of their CFO. That person is managing your money. It's like a business in a way. And you should be judging them more on the efficacy of the plan than you should be, oh yeah, they're my friend. Because money is a business, right? Your wealth and your ability to stay in your home and send your kids to college, that's personal to you, but it's also a business if the person is managing it for you. So you shouldn't let friendship be the driver. You should let, is this a good plan, be the driver. And you should be the boss of your money, and the CFO works for the CEO. Okay, let's switch over to pie chart investors. At the end of this, buy and hold, don't go away, because you want to know about pie chart investing, number 1. And number 2, at the end of this, I'm going to tell you one thing that's critically important for all of you. So pie chart investors, one thing I really want to stress is that 2022 is not going to be like 2021. We saw 27% returns in the S&P 500 last year. That was because we had a recovery year, because 2020 was the pandemic. And then, we were coming back from nothing. It wasn't hard to beat those earnings. This year, not only are we going to have slower GDP growth, slower economic growth, we're going to have rising interest rates. And depending on how fast those interest rates rise, that's going to affect how the stock market does. So if interest rates start rising really fast, stock markets can go negative. Okay. If they go slowly, then we could have still a good return this year. but it won't be a 27% return. We might be, on average, it might be 10% if they go real slowly and the Ukrainian crisis doesn't get worse. I don't know how it could, well, it could definitely be worse than it is now, but if it gets a lot better, then that's definitely going to help the markets. If it gets worse, that's definitely worse for the markets. But as you know, as a pie chart investor, the way that you manage that is not trying to jump in or all out. It's how much do you want to keep safe? So we're saying overweight 10 to 20% safe. So pretend you're a little bit older so that you have less riding on the markets. What does that mean? If you're 50 and you're overweighting 20% safe, you have 70% of your assets safe. There are many reasons why that's a good idea, but one of the most important ones is that if you have only 30% at risk and the markets go down, let's say they go down by 30%, then you're only losing a small amount. Whereas if you had $1 million and all of it is at risk, you could lose 30%. You've been losing $300,000. So the way that you manage risk is to overweight safe, pretend you're a little bit older than you are. So again, here's one of the pie charts, and this is a 30-year-old that's overweighting 10% safe. Here's another one. This is a 30-year-old overweighting 20% safe. And here's a 50-year-old overweighting 20% safe. So that's the first thing that you want to do is I would definitely want to be overweighting this year because it is a tightening year. We do have the Ukraine crisis and assets are overvalued by many. There's almost every measure that you could use. They're very, very elevated. Number two, your rebalancing must be regular. As you know, I always say once, twice, or 3 times a year. There are certain months that are a good time to consider doing it. But what I really want you to do is to be led more by the returns. So if you saw, I mean, we already had told you guys, rebalance. We send out multiple emails at the end of December, rebalance now, rebalance now. And that was because Januaries over the last 20 years have tended to be pretty rocky. Sometimes they're okay, but a lot of times they were pretty bad. So rebalancing at the end of December after the Santa rally, good idea. Again, it's not all in or all out. A slice has gotten too large, you sell high and trim it back to where it should be. Conversely, especially if we have a crap February, like we had a crap January, if the slices go down in value, especially if it's something that's super hot, then you might consider buying more and beefing it up to where it should be. Now, attend a retreat so that we can fine tune how you think about these slices. But the real important headline here is that in addition to having those dates in mind that I give you, the end of December, end of the spring rally, which is the end of April, the end of September, which there might be some back to school stock sales, having those dates in mind, you also want to be led by the market. So if the market goes crazy and it's at the end of March instead of the end of April, and you've made 50% gains on something, and again, maybe it's one asset class or one hot thing. Now on my hots, I actually want a little bit more than that, but we'll talk about that at the retreat, or, you know, we can do some private coaching, or we can just have another video conference just on hot slices. But regular rebalancing now should be led, those dates in mind, but also led by the returns themselves. So that does mean that you should be looking a little bit more. Now, one last thing, remember in the pie chart strategy, you must have an Excel sheet of your holdings that are small, medium, large value growth and your HOTS, so that you can compare what you have to what you should have. There are many reasons why you want to do this. Number one, it prompts you to do what you're supposed to do. So if a slice is too big, it's saying sell high. If a slice is too small, it's saying buy low. The other thing is it's pulling the emotions out of it. If you're reading your brokerage statement, it's jacking with your emotions. There are many subtle reasons why that's the case. So we want to take the emotions out of it, and we also want to have a plan that prompts us to do the right thing. Number three, for pie chart investors, if you have individual stocks in your pie chart, you have to babysit them. You can't just use that rebalancing moment. Like we had Moderna as our company of the year. We listed at 150 and it went up to 500. And then now it's back below 150. So, you know, we were sending out notes saying it's very high. We're sending out notes saying you should protect your profits, but you have to really be monitoring this. If you see something that triples like that, especially again for our HOTS or our individuals, we're taking on higher risk for higher gain, then you got to take those profits. Okay. So that's it for pie chart investors and buy and hold. Obviously, there's a lot more. So whether you read about it in the ABCs of Money 5th edition, attend a retreat, or get a second opinion, now is the time to do it, because as I outline in my blog, which I strongly encourage you guys to read, hold on, here it is again about the Ukraine invasion. And by the way, I will send you over even more data if you just, you know, ask for it. Just email info@nataliepace.com and ask for more wartime data. But as you can see here, a lot of times during the first part of a war, the markets respond very poorly. Now, one reason why I'm listing this for you is because I am seeing a lot of pundits out there blogging and bragging and boasting and blah, blah, blah about how over time that the markets do really well during wars. But I think it's important for you to realize if you lose a third of your wealth, then you're in trouble. I mean, your credit score goes down. You're going to have to borrow at higher interest rates. If you're in the middle of something where you borrowed, that could be a problem, especially if you need some cash to help fund it. You know, once the bull market does arrive, you're going to have to make up losses instead of earning gains. So again, by having the pie chart system, keeping a percent equal to your age always, overweighting safe during wars and during tightening periods, that's why we're overweighting safe right now, and then regular rebalancing, then we're in the position to earn gains in bull markets and protect our wealth in bear markets. Now, that simple pie chart system that I showed you earned gains in the dot-com recession and the Great Recession and outperformed the bull markets in between. The dot-com recession, NASDAQ stocks lost 78% and took 15 years to crawl back to even. So at the top, people were feeling so rich and everybody was bragging in 1999. We were partying like it was 1999. And by October of 2002, if you had $1 million just invested in dot-com stocks, and believe me, there were a lot of people who did, it was down to $220,000. So now is the time to know what you own, to get the pie chart strategy in place, to even think about hot things. What will go up if the markets go down? What could go up if war does break out? How can you support the Ukrainians? Is there a way that you might be able to do that? We just saw that natural gas prices hit a high. Why did that happen? Well, guess who is one of the biggest exporters of natural gas, especially to Europe? Russia, right? So if you're investing in natural gas right now, yeah, you just probably made a boatload. Now might be an interesting time to rebalance, and that might actually help the Ukrainian cause if that's something that you so wish to do. So we can take even beyond making money, we can take ownership as well. All right. I am going to stop the recording in just a moment. If you have a question or two, I probably can take 1 or 2 quick questions. Again, a lot of the information that you're probably really wondering about with regard to the Ukraine is going to be in that blog. And again, it's nataliepace.com/blog, and just email info@nataliepace.com if you'd like a few of the other charts that are not in the blog that I put together. They include price earnings ratios, which I think are very important as well. So I will take a few questions, but I want to give you a couple more resources before I do. So one of them is this. I do provide pretty much daily money tips on Twitter. I don't want to email you every day. I'm sorry that you got an email yesterday and you're getting another one today, but it's abnormal because we just had an invasion of Ukraine. But normally you're going to want to come to my page, nataliepace.com, frequently, and just scroll through my Twitter feed and see if there's any blog that you really want to read and catch up on. So that's one way. Or if you're on Twitter, you can follow me. Here's all of my social media there. Another thing is that we are having a investor educational retreat, and that is March 18th through the 20th. If you register by the end of February, you get the best price. So if you're interested in this, you want to look at it now. Now, day one, nest egg strategies all day long, pie chart strategies. Day two, what's hot and how to avoid the bailouts. A lot of people, not only are they not properly diversified, they're invested in the worst performers in the market, and also those that are very over leveraged and maybe even some zombies. So we want to know how to avoid that and how to get hot. And then day three is all about what's safe. And that's very important. What's safe in a debt world where stocks and real estate are overpriced? That's so important and so key that we have to spend one full day on it. I'll give you the headlines on some of the things that you should be thinking about. So if we go back to the pie chart, you can see here, and again, if you want to take a screenshot of this, feel free to, or a picture with your phone. Bonds and money market funds are vulnerable. Most people, if you have a 401k or even a managed brokerage account, you're going to have your cash in a money market fund, and that can actually lose money. They also can be subject to redemption gates and liquidity fees. FDIC insured cash is safer than both of those. Safe income producing hard assets that you purchase for a good price are best, but the income must consider a post-pandemic world. And you also have to remember that liquidity allows you to buy low. So again, we kind of go through all of that on day three at the retreat. I also have an entire section, What's Safe, in the ABCs of Money 5th edition. That was just updated in September of 2021. It's still very relevant. So back to the retreat. Be sure to register by Mondays for the best price. You can call us or email info@nataliepace.com to register. So there's that, and there's my social media. And then to get to the blog, you can either use that index blog right there, or you can just go nataliepace.com/blog. Okay. All right. So I'm going to go ahead and stop the recording there. And I will take one or two questions before we sign off. Okay, so again, thank you so much for joining me. Again, I'd love to see you at our retreat. I'm happy to do a second opinion if you need it. You know, I don't get rich on the books, but I actually put them out there, especially for people who can't afford to come to the retreat. At least they have the information. So, you know, the retreat is a small investment in, perhaps for many of you, saving hundreds of thousands or more. So it's a good one to invest in. The ABCs of money we all should have received in high school. Now that may make it sound a lot more pedestrian than it is. I will tell you, we have hedge fund managers who've attended the retreat. I've had a PhD in math who attended the retreat. And the reason for that is that a lot of us don't ever get life math. So this is a retreat on life math. If you don't know, in fact, I have an investor IQ test and I have a rebalancing IQ test blogs that are free. You can probably get to them most easily by just Googling nataliepace.com/blog, investor IQ test 2022, and rebalancing IQ test. And you'll probably hit both of them. Take those. If you score 100%, then you're in good shape. If you don't, you need a retreat or you need a second opinion. All right, I will see you soon. Thank you for joining me. Share the blog free. It's free. Share it far and wide. Everybody needs this information. And of course, this video conference will be available for anybody to watch back for free at youtube.com/Natalie Pace. So again, thank you so much for joining me, and I'll see you next month, free conference.